Good morning, everyone. How you guys doing today? I have no voice, so I'm going to be answering any questions regarding underwater options or the SPX via a series of interpretive dances. I have one question with 38 parts. I hate you, Stefan. What happened? I don't know. I lost my voice and I can't find it. Is my SPY 500 call 1 DT safe? No, no, it's not. I'm not sick. I just don't have a voice. You gotta stop eating those strange, extra cheesy tacos. It's bad for the throat. No. I'm seeing Wall Street bets and other retail TA calling for 420, 425 on SPY, win rug. Well, probably at least 2 more days, right? Although I think we have a better grasp on the macro that's triggering all of this, but we'll go into that later when Dork and JFresh maybe show up. I'm seeing Wall Street bets and other retails. Okay. Trick is to relax your throat, otherwise it'll get all bruised. I thought that was your soft palate. You come to me at my daughter's wedding and ask me about your zero DT. Also win market crash. I shouldn't have let you trick me into reading that. Um, are you thinking more push up into SLD or kind of chop in this range before SLD? Well, TradingView deleted my SPX chart from the beginning of the week, but I can kind of pull it up. Probably. Hold on. Boom. Okay, so this is way too zoomed in. This is kind of our expected range for the beginning of the week last week. I think we landed perfectly within it, which we'll take a look at here in a second. But yeah, after finding support on the long term gamma neutral, I mean upside was the right bet. But all of our upside tests, which we'll look at over in futures, have been rejected in a violent manner. There has not been like a soft rejection or a persistent retesting of that 4170 4175 level. It's very similar to the price action that we saw leading into February SLD, where every time the market moved up, futures dumped on all the zero DTEs and it went right back down again. We're continuing to see that this month. So I think SLD is going to bring some significant downside. I don't think any of the macroeconomic data that's come out recently has been particularly bullish. It hasn't been very bad, but oil prices are up in this month, which is going to put pressure on PPI and CPI next month. Core CPI has advanced over headline CPI, which is relevant, and that it means that durables or less volatile measures of inflation have increased beyond the more volatile measures of inflation, showing that inflation is becoming entrenched, and it's becoming entrenched at a pretty high rate. Entrenched inflation at 5% is a pretty big deal. I think that's being realized slowly. We don't see any evidence of a bull market. As much as a lot of retail is convinced that we're in one, um, and even some analysts. Uh, the evidence isn't there. The money flow still isn't showing any positive signs. Money market funds are still growing hand over fist. Um, yields are up, which is going to start making them more attractive again. I think the 2 year hit 4.1 again um, on Friday. We've got no leaps being bought on SPX. No long term entrenched long positions are building on anything. Even the stocks that have been running so hot and positive over this last like 2 month period, like Nvidia and Microsoft, are starting to see their gamma shift negative as more and more calls are sold and more and more puts are bought. So yeah, I mean, I don't really see the case. Anyway, alongside this, upper range prediction for this week, we see where we ended up, which is right here, and kind of closed Friday out just under that long term trend that goes back to August. This is a little bit above the longer term trend that goes back to December, but still a difficult resistance to cross. And I don't think we'll see higher highs going into this week, into the early part of this week, but it's still possible. If you look at yes, you can see where those rejections are occurring. Um, Across the last 2 weeks, almost every test in this upper range has been rejected back down like 80 to 100 basis points. So there's some thoughts on why this would be. um One thing that got brought up was maybe JPM's collar hedge is from the collar that was there in February, um, is still kind of entrenched in this 4,200 range, like high 4,100, 4,200. So like let's say 4,150, 4,200, and because the collar closed and rolled, down around 4,080. Um, they still haven't shed their hedge from that collar. And so, part of this might be them getting out of the hedging that they did on the collar before the market tanked. That's pretty speculative, but it's something to consider. We have some more macro things that we're going to point out today, but that's one that we've been kind of looking into. A lot of like the ES contracts that have been closing out in that range on these tests were bought back in like early January and February, which is more noticeable because it wasn't the contract in front at that time. Puts on my espresso machine. I just haven't had a chance to. I'm supposed to like. I'm waiting for a part, and then I have to clean it, and so Starbucks is very close and awful. DCing into 5.5 slightly out of the money SPX puts. Would you get shorter dated SPX call hedge for possible futures pump on OPEX day? You mean going into next week? it might not be a bad idea to hedge the upside after SLD. There tends to be a little bit of a bounce, generally speaking, within a couple of days of SLD winding down. So, I'd probably be prepared for that. Why is the GME floor price only 185,072,750? I have no idea. Over the past year, every pump to 4,100 has been followed by a 200 to 300 SLD dump through OPEX T+2. Are you seeing anything different this time? No. No, I don't think so. Most of the call positions that came in at the end of this week, especially the ones that, drove this final big pump, most of these were dated for 421. A lot of them were closed Friday as we fell off into the latter half of the day. With a bunch of them also closed out on the bounce into close. So, obviously profit taking on the long side is becoming more and more encouraged. Earnings this week, thoughts on what you were looking for? I mean, not a lot of earnings this week, right? Tesla's this week. I know we have some more bank earnings tomorrow. Obviously, those carry a similar risk to the bank earnings on Friday. Um, what other earnings are this week that are of note? I don't think too much of the S&P 500 is being reported just yet. I think most of it's going to be like late April through early May. I mean, Nvidia's starting to slump, right? It's taking a lot of time. But if the market pulls down, it'll finally pull down below gamma neutral, which it didn't, it was nowhere near doing back in Feb SLD, right? When Feb SLD hit, Nvidia touched gamma neutral briefly and then bounced right back. The market continued to move down, right? And Nvidia stayed stable throughout almost the entire period. This time, Nvidia is already right at gamma neutral. I'm just gonna pull up the chart here. Um, Nvidia's basically right at gamma neutral, which is right around here at like 264. So it's much closer. If it slips below, then yeah, it's got some more significant downside potential now than it did back in early Feb. Here in Fab, when it pulled down to gamma neutral, it recovered immediately. Um, it stayed in that positive gamma environment all the way through this period, right? And so now we finally have a chance for it to slip and fall into a lower range and have some of that market maker hedge work in our favor. What about Netflix? I mean, Netflix is it's like a SPX QQQ adjacent play, right? Um, I mean, the Head and Shoulders is breaking down here. This doesn't look very strong. It had a small breakout above this like lower, lighter resistance trend, but continuing to stay just on trend. This isn't particularly bullish, right? The breakout is breaking down, um, and it's in a great range to purchase farther dated puts like 60 to 90 DTE, even like 40 to 90 DTE, depending on how close to the money you are. I think a breakdown towards at least 300 is likely. And given enough time, it may see even lower after quarter one reporting. Do you think China GDP could have a big effect this week? I mean, maybe if they lie about it again. How much theta do you usually get for SLD on SPX? Not generally a lot. Like 2 weeks out expiration, which is usually about like 17 days, 14 days. I play zero DTs on it too, if it's like confirmed. Downside support on Nvidia. I mean, I want to say like 260 and 250 are going to be very important. A breakdown below 250, there's not much support, but there's a lot of puts. So I think once it moves into like a gamma like negative environment, it's going to move down pretty quick, especially if the indexes follow suit. And the same compounding effect that we saw from ETFs on its way up, we would also experience on its way down. Congressional DoD meeting about UAP balloons Wednesday. That doesn't seem very important. How many tests of resistance or support determine if it is a strong level for you and what time frame? I generally draw support and resistances between like the 1 hour and daily. Um, I don't really know if the number of tests matter for me. I mean, obviously, the more the better, but what's more important to me is the volume and the stock's reaction to those tests. Does it bounce hard? Does it have weak bounces? Is it rejected hard, or is it a weak rejection? Does it eventually, turn from resistance to support? That's the kind of thing I'm looking for. Does WeBull allow SPX bear call spreads? I believe so. Yeah, on a margin account. $200 to $300 drop would put SPX at 39.50, 38.50. Does positioning support that big of a move yet? No, I don't. I don't think we. I mean, I don't think we support a move down to 39.50 right now, and definitely not 38.50. SLD isn't 200 to $300. It's like 200 to 300 basis points. So you're looking at a drop to like 40, 50, or 40, 12, roughly, from our current range, which could lower by the time we get to SLD. But then, you have the post SLD. Usually that bounces back. And then you have to see where people reposition once the SLD settlement starts coming in, right? So, you generally get like your SLD drop like this. And then that can recover a little bit, right here. And then you either see more put positioning come in. Sometimes you get like a little rally from it being oversold. And then, as more and more of the settlement goes through, you can see more and more downside. But that takes a little longer to be realized. Sometimes SLD is just kind of straight down, like it was here in December, right? With very little oversold bounce back. Um, it can vary, August, kind of goes straight down, but then there's that oversold rally, and there's like a little recovery, and then, shorts repositioned back to the downside, right? Shorts don't always reposition back to the downside. Sometimes they reposition back to the upside, which is something you can see here after like June SLD, right? Which was actually right here. Um, So, we're already very low during June SLD. So we did get some sell off, but that recovered quickly. Um, and then by like early August, most of the positioning had been up, right? And so we started to climb. Having the market at a high when SLD hits is generally bearish, right? More participants are willing to forego more positioning in order to gain greater leverage into the next period. It doesn't appear as a recoil should occur from all the shorting. I mean, a lot of the things going on right now also just don't affect VIX, right? So, the market's being driven on the back of these like 0 to 14 DTE options. Um, and then, those are being protected by futures, right? And so VIX is only really being affected moderately by the hedging of these positions and the hedging of positions on VIX. Um, and so, not a lot of the current price action is the kind of price action that would drive up VIX, right? Because VIX is based on a spread of options on SPX that are 23 to 27 DTE. And these are generally transacted in like a fairly illiquid auction process that determines the pricing. So it's two components there, right? Like, yeah, there's large volatility shorts, but also a lot of the positioning on major indexes right now isn't something that would push VIX up, right? And so VIX is kind of ignorant of the price volatility that's being conducted in the short term. Don't forget, too, in this environment, a 300-point SLG drop could be a catalyst to just fall off a cliff. Yeah, it can be. How risky do you think weekly SPX bear call spreads 200 to 300 BPS out of the money are? I mean, they're obviously pretty risky, right? Oh, wait, hold on. Are you selling them in the money? Or you're selling like 4,500s? I mean, why? They're not they're not worth anything. So you're taking on $500 of risk to get like what, $30 credit? In the money ones, I would say would make sense, but would be risky, obviously. That's a very odd question to ask about risk. You've named like one of the least risky positions anyone could think of. Is there a time SLD didn't cause a drop, or generally pretty safe to position bearish for next week? I mean, yeah, there's times where it didn't cause drops, but it was usually after risk offs had already occurred, right? So like um in March, like leading into March, OPEX, SLD didn't have much of an effect, but um, you know, the market had already risked off massively in the prior like month with the Ukraine war and everything. So there wasn't a lot of like selling going on here, right? Um, I think this is also true back in like October of 2021. You know, when we hit SLD, which was like right around here, the market had already sold off pretty significantly, approaching it, right? So I think anytime you see like a big risk off in advance of SLD, you can assume that most securities that are going to be used for deposits were sold back here, right? And they're not going to be sold during the SLD period. An entropy swap on the VIX would be less risky. Yeah, if you're 200, if you're selling the problem with spreads 2 to 300 BPS out of the money on SPX, right? And you're talking like Jesus, like at like 4250, 4200 to 4250 roughly, right? The chance of these going in the money is extremely slim, right? And then additionally, your max risk is only the spread in the contract, but the problem is the credit is awful. So you're taking like $500 risk for what? I mean, I don't even think these are probably like $50. Is that even a 10% yield? Can you talk more about protective puts versus in the money covered call in the rare event of a crash? Benefits to either, which are safer. Do you always carry protective? No. I do sometimes, pretty rarely. Generally speaking, if I think the market's going to crash, I'm just going to sell a bunch of in the money covered calls. And then if I get assigned on shit, I'll just buy it back later. I mean, both ways you're getting delta exposure, right? One of them's just free, but almost always I'll sell calls before buying any protective puts. Some stocks, where my position is really good, I might do both, right? Because I don't want to lose the advantage I have with my low cost basis. So like, I'll just go synthetic short. I'll sell the call, like in the money, right? I'll get my negative delta there, and then I'll buy like at the money puts or in the money puts with the credit, and then I get more negative delta exposure, right? Then even if I do get assigned and it doesn't like, say like AMD is a good example, I guess, because I actually have that position on AMD now. I have I think they're 60, $50 covered calls for 2024 for Jam. And then, I went and just took the credit from that and bought puts. I bought them here, here, and here. But I've just continued to buy puts on it, right? And that way, if this doesn't fall to my cost basis, say it only falls to like 64 over the course of the year, and I get assigned on these, right? Then, the money made from these puts will offset the cost of me buying back in at $64, right? For synthetic shorts, you do a 1-to-1 ratio. I mean, generally speaking, you have to. Um, Usually you don't have a choice. You could also use the put profits to buy back the so, if this drop happens by, October of this year, I can sell the puts and then close the covered calls. And I'll still be, positive P&L by a pretty decent margin. I'm starting to use my margin account for CSVs, and then if assigned, move to covered calls. That is wheeling. Is your risk for margin calls high on CSPs? I don't think it would be, right? Generally speaking, no. But in the event of a market crash, yes. In a bear market, I think your risk of margining covered call or CSPs is pretty high. Because say you're selling like zero point 0.2 delta, right? Um, and the stock falls enough in a bear market for this to get assigned, there's a pretty good chance the price of the stock is going to keep falling. And this is where you run into your margin call issues. And the delays in being assigned and selling the covered call can be a real problem when something like this happens, right? Because you get assigned on the CSP, right? But it may not be in your account before the stock has lost another like 3 to 5%. And then by the time it's in your account, you might already be at the bottom of the trend. And so you're going to try to offset risk by selling CCs like in the money, right? In order to pad your margin. But then, it might just turn around and then you get fucked going the other way, right? So selling CSPs is really, really generally pretty risky in a bear market. They're great in a bull market. I mean, you're probably better off doing spreads right now because you minimize risk. You minimize risk to the spread, right? So, you can have your risk at like a max risk at like 100, to like 300 on a like $1 to $3 spread, right? You still get to harvest the theta. It kind of shits on your yield a little bit, but you can offset that by going closer to the money. I have April 21 SPY 400. They're down like 80%. So SLD may get me out with less losses. Yeah, that's probably the best hope. I hedged them with upside calls so far. Smart. Hey Girk, great week last week. I had a question about SQQQ strategy. I've been buying SQQQ under 30 a share with the potential of upside coming, and wonder what would be best to sell CCs or sell the shares if they increase substantially in value. What is too long of a hold with SQQQ as well? I mean, with SQQQ, it's like buying a stock that's an option, right? You have you have built-in volatility decay in the fund, right? And so the value of the underlying is always dropping over time. And so generally speaking, they're not an excellent long-term hold. However, IV on SQQQ stays relatively high. And if you buy SQQQ in a really good range, uh, for that time period, then you can sell covered calls against it to offset that volatility decay by selling theta against your position. um I would probably see how SLD shakes out, and then if I didn't like the way SLD looked, I would consider selling like at the money or in the money covered calls. um that's usually how I handle as like any SQQQ positions that I get assigned on. um I do sell a lot of CSPs and occasionally covered calls on it. Sometimes you get assigned early selling CSPs on it, and then you need to use covered calls. But it sounds like you're right in the perfect window for those to realize some upside. So you might just get your exit and not have to worry about it at all. So GME, that's a good question. You know, right now, hold on, I gotta set this up. Give me 1 second. Oh, you bitch. There we go. So GME is getting more illiquid pretty rapidly. The market has been, you know, if I overlay SPY, the market's kind of been ripping. Um really? Is it gonna do it like that? You fucking piece of shit. There we go. So yeah, the market's kind of been ripping and GME has remained flat, right? In a period where, you know, it was moderately illiquid and probably should have just tracked with the market. This difference is, you know, a lot of what's driving the consistent negative arbitrage that we've had since, you know, earnings. I would say that due to all of the internalization, a lot of the liquidity that would have been gained during this period has been eaten up. With ETF FTDs ending this week, we'll see if they're able to, you know, kind of recover some liquidity here or do some covering into a downturn in the market, which is the most likely scenario. If we see that, they're likely going to short into April OPEX. If the market doesn't pull down hard this week, or sufficiently for long enough, and they're unable to get any liquidity on GME, then I think we're rapidly approaching another liquidity event. So I would be cautious with covered calls. I mean, obviously, I'm going to keep everyone updated on the liquidity here throughout the week, and I wouldn't worry about it too much. I don't think it's going to work out great. You know, none of the other signs of a liquidity event are there besides the liquidity drying up. So, yeah, we don't have like the ETF calls coming in or puts. We don't have, you know, any vol positions moving around on GameStop right now. It looks pretty fucking boring except for this. Quick long short thesis on AMD, or can I read up on it in Pickle's picks? I mean, I think they're kind of gonna face the same issues that you know, Nvidia and the rest of them are facing. Especially if there's any problems with TSMC. Samsung's a big manufacturer for Nvidia. Their revenues are way the fuck down. The embargo on chips to China hurts Intel, Nvidia, and AMD equally. Um, I don't expect AMD to actually drop as much as I expect Nvidia to. I think it's more fairly valued, but I do expect it will see some downside before the end of the year. Also, its index exposure means that any steep correction in the overall market is going to lead to significant downside price action on AMD in the same time frame. So, as someone who's quite long AMD, I figured the best bet was to protect my shareholding throughout 2024, 2023 into 2024. I'm not sick. I just blew my voice out. Seems like you're wasting long-term holding status by taking profit in the form of short-term cap gains. Why not just sell the shares and buy back later? How am I risking my long-term holding status? Oh, are you one of the people that don't know that brokers don't report in the money covered calls to the IRS? So here's a fun fact. Brokers don't report in the money cover calls to the IRS unless they get assigned. So if you buy them back or they expire out of the money, your long-term holding status stays the same. Never once have I seen a broker report in the money cover calls unless they were closed or exercised in the time period. They still report the premiums. They just don't report the change in your long-term holding status. Hey Greg, new trader here. Does the premium option include wax and air dry? I can't find it anywhere like normal car washes. Morning, bud. Hope you're able to rest your voice later. Was that Starbucks cup I just saw? Yes. Sorry if you answered. Kids came in yelling. Don't we also have a holiday that could defer OPEX? No. There's no holiday this month, right? Is there a holiday? No, there's no holiday. There was a holiday earlier this month. That has nothing to do with OPEX. Mr. Poopy Pants, mind blown. The premiums are short term, though. Okay. I mean, that's fine if I carry my shares, right? So I just get an interest free loan. That lets me buy a bunch of puts. I get 2x leverage to the downside on the stock I already own for no upfront cost. That seems like a good deal to me. Can these Rex codes defer obligations to last Good Friday to kick it 35 days again? No. I mean, even the Rex codes that I was using to try to determine like the settlement periods in January, like all of those holidays fell on OPEC settlement periods, right? Or the deferral period from FINRA fell during the settlement period, right? The Good Friday holiday settlement period isn't deferred. Like it doesn't defer anything from OPEX, right? You took profit from your cost basis as a short term in the form of premium, is what I'm saying? Yes. Which, if the price of the stock drops, is just hedging, right? It's only really an issue if the price of the stock doesn't drop, in which case, yeah, that would suck. But I think worth the risk given the macro. Pretty sure upstart price action for the week. Think we hit a new low? No. I think Upstart's going to continue to probably get shorted down now and sell off. They've swung liquidity back favorably. The ETF FTDs are resolved. It'll probably be off reg show in the next week or so. Or at least I wouldn't be surprised if it is. If it goes into OPEX on reg show, that might be exciting. But right now, there's plenty of time for it to fall off. I did get assigned on some out of the money CCs on it on Friday, which has happened a few times on Upstart and is particularly odd. I think it's because I'm selling them in the money, and so when they fall out of the money, it's still worth it for them to exercise the arbitrage because I'm taking like the worst possible price on the contract when I sell it. But it's still weird. It still feels weird to get assigned on out of the money calls. If GME runs due to OPEX obligations, then not due to the ETF buy-in, then correct? Yeah, if GME runs during this period, it would just be due to any obligations that were created during March OPEX. This would be off of like Turd's ETF thing, like the ETF and ETF FTD cycles that he was pointing out earlier this week. That I've been pointing out for a year. Well, anyway, is there a heavily skewed positive delta in the money calls versus out of the money puts? Negative delta is there to incentive for MM to mean revert to de-risk collect premium? At what point do they stop hedging the upside? Generally, once it's gamma negative. What strike did you sell Upstart and get assigned? $16. It was shares I bought last week. I bought them at 18, sold them at 16. Um, and then the 16 CCs got assigned on Friday, even though they didn't expire until next week. I assume there was arbitrage reason for it, but all 10 of them got assigned. That's still on Reg Show. I mean, fuck it. I don't care if they want to pay me the extra premium to cover their liquidity issues. I'm fine with that. It sucks that I didn't get the shares to keep, but what are you going to do? All right, let me see if could you touch on Google? Yeah. My spreads got shot when it ran past GM and stayed there this last week. Was curious what your thoughts were. Let's see. Did this run past GM? I don't think it did. It's just over. Delta neutrals at 97. Gamma max is at 136. Google, it's a little closer on Goog. 112.50. So still, yeah, it still stayed under gamma max all week. And Google almost never breaks gamma max. I can't think of a time when it actually did. I mean, this isn't really that far outside of its prior range. A little bit of this gap from back here filled in. Uh, maybe up to 110. I know I had to roll out. I had to roll out a couple spreads at 105. I think I rolled them up to 110, but I don't have the broker open right now. I'm pretty sure I rolled them up to 110. A breakdown from this price point is pretty likely. At worst, you fill the gap in up to like 109. 109.98. What are your thoughts on VIX during this SLD period? Well, we have VIXpiration on Wednesday for the month. Uh, that'll probably be interesting. Generally, that drives up volatility the following day. Uh, that's going to be Wednesday morning. Um, so Thursday, we might see more movement on the VIX. Are you still in the play? Yep, very much so. Unfortunately, on FSLR, I did not get the entry I wanted for the shorter dated puts. So right now, the only positions I have are like 200, 190, and 180. And those are like June and September. Um, I think I have some, I think I might have some 180, 175s also, or 170s. This one I can't remember. Um, but yeah, I wanted to enter 205s and 210s again. I bought into them, back here, and it was really good. But it never really got up to the price where I was comfortable buying those. Those would have been my shorter dated puts on this. But yeah, I'm still in the longer dated positions. It's probably bearish that it was unable to regain that like 220 to 210 range for any significant period of time. My expectations on their long term is that they're still going to be unable to meet demand this year, and that's going to contract their margins. Given that their margins are priced in the expectation that they're going to expand, and I think they're going to do the opposite. I mean, obviously, it's not a guaranteed play, but if you do some digging into their financials, you'll see that they are very very far behind in production already, and that's only getting worse as demand for their product increases. I thought GM was 106.46. Maybe that was last Friday. When did you ask about it last? Was it like it would have been on the 9th, right? So this was the value from the 6th. Yeah. So that would have been before Good Friday. All right, let me see if Dork and JFresh are around and they want to hang out for a minute. All right. Wait 1 second. All right. So assuming FSLR can improve their manufacturing volumes in the next few years, next few months, Does it seem like a good play on the bull side based on the high demand? Oh yeah, absolutely. I don't think they're a bad company. I don't think they're going to fail in the long term. I think they've got plenty of subsidization in order to keep going for decades. But yeah, for now, overvalued, and unprepared for their contraction in earnings, which is inevitable if they need to scale out more manufacturing ability, right? Like they're going to have to increase capex, which obviously increasing capex during a near recession or whatever they want to define our current economic state as is not great. Definitely something their investors aren't totally prepared for. What's up, Jay Fresh? Nothing? Oh, all right. Well, Jay Fresh is in here. I don't know.
I'm here.
Oh,
Sorry, my
there you are.
headphones were messing up.
No worries.
What's going on?
Not much. Just planning on the economic collapse of the U.S.
Yeah, I didn't watch any of the stream, so I have no idea what you guys are up to. But
Just talking about stocks.
stocks,
Yeah.
is that what we do here?
Right?
Which stocks?
I don't know. We're talking about FSLR, Google, Netflix, Nvidia, GME a
Do
little
we
bit, and Upstart.
do we talk about TSMC at all?
Do you want to talk about TSMC and how absolutely fucked they are?
I kind of a little bit. Also,
Okay, yeah.
you sound a little hoarse.
I'm
You got a
my
thing going on?
Yeah, my voice is blown out. I was sucking way too much dick over the weekend.
Oof,
Yeah, you know
happens to
how
the
it
best
is.
of us.
Dude, I had to pay for my puts. Yeah.
Got it. Yeah. No. Yeah, TSMC looks like they're gonna come in under their guidance, right? I mean, they've TSMC is nice in that they tell you what their earnings are before the call, right? So we already know. We literally already know they're coming in under their guidance. I guess it kind of depends on what the exchange rate is between whatever the hell they use there and the U.S. dollar over the last quarter, which might be favorable to them. So maybe they'll come in on the bottom end, but it doesn't look like they've made good money. And this current, March was terrible for them, absolutely abysmal.
Yeah. Yeah.
So hopefully,
Well,
I don't know.
I mean, they're not making chips for China right now, due to the sanctions. Nvidia's obviously, we already know, not making any new chips because they still have $5 billion of ones they haven't sold to anybody, not even Musk. Um, so yeah, I don't expect their earnings to be very good. There's a big slowdown in the semiconductor space that's not yet realized in their earnings. I was hoping it would be obviously in quarter four, but it definitely will be in quarter one.
Yeah, will it be enough to start the trend down? Is what I'm wondering. They'll find a way to ignore it, right?
Yeah, I mean Buffett just sold, so that's a pretty big
Yeah.
slap in the face, right? Citing eventually, I think one interviewer got him to cite some of the political turmoil as a reason that he sold, but his initial reason was possible seismic activity, which was the first time, which I think is the first time I've ever seen Buffett just straight up lie about why he sold something. Usually he's pretty upfront because of his autism, right? But not this time. And that's
Everybody's a geologist.
yeah, that's pretty interesting, right?
Yeah.
I
I
mean,
mean, it's also obvious.
given that Buffett is, probably at the center of everything that the Democratic Party does at any given time. I'm sure he's very aware of the risk of war there.
What's up, guys?
What's up,
Hey,
man?
man. We're just talking about how NVIDIA is going to go to the moon on the back of bad TSMC earnings.
Oh yeah, it's gonna be so bullish.
Yeah, TSMC not making any chips, NVIDIA not selling any chips, both of them to 500.
Why not?
I mean, they just sell AI now, right? So it's all about the soft goods. You don't need hardware anymore. The fucking hardware's burnt out. The chip dies can't get any smaller,
No,
right?
no, no, no,
So
no, 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 no. No. You only invest in the hardware and not in the soft goods, but you talk about the soft goods
I say,
because nobody's investing in AI. They're
but
investing in
but
chips that power AI.
but Jensen told me that all the chips that are made are already the best chips that'll ever be made.
I don't know. They'll get better.
That's not what Jensen Huang said.
Well, so you know who stands to benefit the most from the cranking of soft goods out of anybody?
Me?
Carl.
No, yeah.
Oh God.
Carl's been cranking soft goods since the stream started, and so far he hasn't produced one tangible hard good. But one day,
His tensor processing unit is just about burned out. Sorry, Carl. We love you.
Yeah, we make fun of Carl, but it's just because he's so awesome and we know he can handle it.
Yeah, that's right.
I also think he might kind of get off on it, but let's not go there.
Oh yeah, no such thing as bad publicity for Carl.
It's true.
Oh, did you guys talk about regional banks? When are those guys doing the
Oh, do you want me
their
to do?
earnings?
Do you want me to go into the whole pitch
Yeah, to pitch.
on why everything's fucked? Should we tell the public? I think we should.
Wait. So well, let's just stick with regional banks first, because
Okay.
just to be specific, I mean, I don't see regional banks doing too terribly in earnings.
You mean the ones that are left?
Yeah, I don't see them having a problem right now with this earnings cycle. Like any future things are going to be just like SVB, where they're just like, oh my god, things are happening. And guess what? We're bankrupt.
Here's the problem with
people are
regional
going to
banks.
be.
Their risk is very divided. Some are very exposed to business lending. Some are very exposed to consumer lending. Almost
Yeah.
all of them across the board have varying degrees of MBS risk that investors are likely not accounting for. Um,
And
FCR
ABS, right?
FCR definitely carrying the biggest risk of something out of all of them, right? If there's one thing we learned from 2021 is that if you see someone get bailed out, it's so someone bigger doesn't fail. And I think that might very much be the case with FRC.
So what? So yeah, that's interesting, and we can definitely sort of squirrel into that, expand on that. But do we think that we'll learn anything about FRC and other regional banks that we don't already know in this round of earnings?
We
We'll get there.
could if big bank exposure leaks something, right? We're not through all of the banking earnings, right? At least not the big banks. We're through most of them, and so far things look good, but they're not over. We still have more coming in this week. So there could still be risk there that's unaccounted for, and then there's also risk in CS, right? And CS is
And CS, of
I'm gonna
course,
say the
we're
word.
talking
I'm gonna
about
say the word
computer
like
share.
I'm gonna no. Talking about Credit Suisse, the CS that matters. I'm gonna say the word though. Their swap exposure The Swiss national government voted down the referendum to fund them, or fund Deutsche Bank, or UBS, or whoever the fuck it was, UBS, right?
Yeah.
To fund their bailout of Credit Suisse. So that's looking rocky. And remember, if that risk doesn't get resolved soon, it's going to become exposed. Like
So
they can't freeze those swaps while all this goes through. That
what are
that
the
that
kinds of
counter that
things we should be looking for with the regional banks as
um
they
uh,
give earnings?
so I think both of you guys know that I've been investing pretty heavily in some regional banks,
Yeah.
mostly selling CSPs on them. The fucking Ivy has been amazing. I mean, 20% yields for a couple weeks with no real news is phenomenal. That's starting to dry up. The real risk for most of them is consumer credit. Most of them are overexposed. I would say across the board, consumer credit's an issue for most regional banks. That bleeds over into MBS exposure,
Hmm.
most of their MBS exposure was created between like 2018 and 2022, and in more favorable credit environments, and that's bled over. One second.
Yeah, I mean, I think probably that's right. The most immediate thing to look out for is the consumer credit and seeing how that's evolving. MBS and CMBS probably will come later, but I wonder how much more people are going to be sort of digging down and really scrutinizing all of these banks as it comes through, and sort of not wanting. I mean, I think people are pretty skittish, and they are ready to dump any bank and any sign of anything, right? And so you would imagine that these regional banks, when they give their earnings calls, that they would try to get out in front of anything that might look questionable, but we'll see. Maybe they just kind of Jensen Huang it and start cranking soft goods at the bank.
Yeah, I mean, the consumer credit thing, though, like the issue with that in recent, like for just like the next earnings, is that unemployment is still low. People are getting squeezed, but they're not getting so squeezed that they're declaring bankruptcy or being largely delinquent on their payments, right?
Yeah,
Delinquency rate.
yeah. So and I don't know that they would really even dig that deep down and say what their delinquency rate is, but I think their change month or quarter over quarter in the amount of consumer credit that they're holding will have slowed substantially, if not even flattened. And I think that will be a big tell when people are starting to stop asking for more credit. Is sort of like the beginning of the ride down.
Absolutely, it could be reflective of something in the economy, but it's not. That's just from not from my perspective. I personally, what I think, but that would just be a sign of the consumer, uh, easing up, being a little more smart with their money. If you're an analyst, that's what you're thinking, right? The bull case is always there. That this is just a little blip because reasons. Um, and so like delinquency rates are about 1% on all credit, like all consumer credit. So I mean, like it's you're not getting specific with that. Who knows? There's more concentration of delinquencies in certain parts than others. But I think that delinquencies on auto loans are probably going to be the first thing to happen in any sort of actual squeeze in the consumer, because you'll keep your credit card balance alive to pay for groceries, but what you will do is you'll stop paying your car payment, or you'll downgrade to a cheaper car and hopefully a lower monthly payment, or you just trade it in for something with like cash outright.
Yeah,
Catch me up.
yeah.
I just died real quick.
Oh, we're just talking about regional banks and
Oh, okay.
seeing if
Auto
there's
loan
anything.
exposure.
Yeah,
I mean,
I think the auto ABSs that they have
That's
are
certain banks. That's like very
yeah.
specifically like Santander, Ally.
So it kind of
yeah,
seems like at least for this quarter, there might be a surprise, but it's not like we're expecting any sort of major, discrepancy or major red warning sign flashing in any of these bank earnings. And I know you said there could be something happening in the big banks, but it
So
seems much more likely that they'll
some
be
risk
doing
that might be
fine.
present that maybe not addressed yet is the CMBS.
Yeah, but is that going to happen now, or is that going to
It's
be?
been happening. I mean, Blackstone's been, doing their soft default on like a trillion in debt, right, for a little
Oh,
while
that's
now.
true. Yeah,
Yeah.
they cut off withdrawals, right, for a few months
Yeah.
now.
So if we start to, in earnings, we could see effects of those defaults, especially on these smaller regional banks that do hold a lot of like CMBS paper, right?
yeah,
Yeah.
and so because it's also Q1, we'll also get the 8Ks, right?
Mm-hmm.
And I'm especially with JPM, I dug through their 8K and they look. Um, I didn't look through Wells Fargo's too much, um, which I probably should, but those are kind of the places where I think people are going to be looking for that kind of risk, especially now that they're coming out with those, right? And
Yeah.
I think it's what everyone's been waiting for.
I guess another thing too are sort of bank runs, right? So I guess we'll also be looking at sort of at the granular level per bank, because we already kind of know how much money is exiting banks sort of in mass from the data that's published by the
Yeah.
Fed. It'll be interesting to see. I mean, we all kind of know that
I
it's
think the
all coming from the small and regional banks and flowing mostly into money markets, and some we've already seen has been flowing into large banks. But it'll be interesting to see how much money has actually flown from any banks, and if there's one bank that perhaps is an outlier in that respect.
Yeah, I think that the depositor shift, it could lead to a decent amount of concentration risk in the banking like sector in total, which is not good. But I don't know what the lasting impact is going to be on this sort of move to redistribute capital around to make sure that your FDIC insured. And it probably does, it does bode well for the big banks for now. But when they get those deposits, they got to do something with the money. And with tightening credit conditions, right, the only place to park your money is in treasuries.
Well, or reverse repo or something similar.
Yeah,
yeah.
reverse repo too, but like for
They've probably already
long-term
maxed out what
assets.
they can do.
Yeah, exactly. And so they got to go get treasuries, and then all that does is concentrate the duration risk into a smaller amount of organizations, which is very risky for the Fed.
Yeah.
I would say that in the near term, the biggest risks to the um, regional banks are probably in order. One, depositor credits or withdrawals. Let's say this is going to be the biggest effect that everyone's looking for in regional banks, right? Is how much money went from regional banks to like JPM, Wells Fargo, etc.
Yeah, but I don't know if it's going to those. I mean, some of it is obviously right because
It's
their
going to their
holdings have
money market
increased,
accounts, right?
right? But it's. I mean, at the end of the day, the the fundamental thing that the banks simply can't reckon with is that I can take my money that's currently making essentially nothing in their bank
Yeah.
and go and start making for even closer to 5%, pretty much risk free or just about risk free. And they don't have much of an answer for that because they're
Well,
already sitting on a
most
bunch
of
of.
the regional banks are and then this is one of the reasons I know depositor withdrawal is bad, right? Is that most of the regional banks have started offering programs of like 4.1 to like 4.5% on savings. Most of the brokerages have as well, which is interesting.
Well, I get the brokerages because they're actually just holding the cash, right? I
Yeah,
mean, but the banks aren't. So how, and they're already tied up in toxic,
I mean they're
low
just trying to
interest.
stop flight, right? Because they need those creditor deposit, like those depositor credits to float the rest of their
But,
positions.
but where are they getting that return?
I mean they'll just treasuries, yeah, high yield corporate bonds. Um,
I guess here's my issue is
they're
they're
gonna
all
take on
already
more
holding,
risk, right?
but they're all already holding those things. So before all of this started, they took all the money from their depositors and they bought bonds at
Yeah,
low rates, right? So they're sitting on a portfolio of unrealized losses already, and they've already allocated all of that capital to these illiquid instruments, right? And so now people are leaving, which puts pressure on on those unrealized losses to sell at a loss and give them their money. And so so now you're saying that they're offering over 4% to park your money there, but with what instruments? They have no free capital. They would have to take on massive unrealized losses to get the liquidity to go buy these higher
massive
interest instruments.
unrealized future losses.
So, I mean, are you implying that they're going to the Fed and taking their deal to get liquidity and then dumping that into higher interest?
I mean, that's the exact rebound effect that we saw in the bond market, right? Fed opened up the backstop, everyone went and bought bonds, and literally just averaged down their shit portfolios with free money from the Fed. That's the only option they had, right?
Yeah, I suppose so. It'll be interesting to see how that evolves over time, as it seems like that
I
is
mean, not well.
shrinking.
That facility is only active for a year.
Yeah, but it seems like that facility is actually already shrinking, or maybe I misinterpreted the data and it's just growing at a slower rate.
Well,
But
don't
I
forget that
thought
the Fed's still dumping their MBS bags on the
I
bank
yeah,
from '08.
I know.
So, I
Yeah,
mean,
it's just not immediately clear to me that this is a winning proposition for them.
it's
It
not.
seems like,
Some
yeah,
of them are
this
not.
seems
Some of them are
dire.
not exposed in that way. There are regional banks that are not facing those conditions. Like PNC looks pretty good across the board. They don't have a ton of MBS exposure. They don't have a lot of consumer credit exposure. Um, they were pretty conservative through 2020, 2021 with their, incoming depositor. And so their depositor, like their liquid cash to depositor demand is pretty high. Key Bank, Fifth Thirds, those all look pretty promising. Some of these banks have a lot more consumer credit risk. Some of them have a lot more treasury risk. Some of them have a lot more MBS risk. All of those things are breaking down. So it's a question of, which one breaks down first. And the answer was treasuries, right? Which, we were talking about back in like November, December, October.
Yes, you and my stonk daddy were discussing that. That's true. Um, well, maybe
Right,
we should
right
lead
around the
in.
time
Maybe
that
I
you
should.
got full bull.
Maybe we should. Hey,
It was a great, that was a great rally. I was there for it. I know.
that one was nice. This current full bear is painful, but I'm confident it'll turn around at some point. I'll be dead by then, but it'll turn around. No, so let me kind of squirrel you towards I think what we're ultimately going for. Your tinfoil hat theory. Everybody put on your tinfoil,
Oh yeah, wrap it on
or
tight,
tighten it if it's already on. Um,
because things are about to get weird.
so
So
so another way that these banks that are holding all these low interest toxic underwater assets they can hedge that with swaps, right?
Yes. So you would, you would hedge your risk on these hold to maturity securities with inflation swaps, where you would, find a counterparty and, you would discuss a future interest rate, and then, you would pay for it a fixed cash amount every month on that swap in perpetuity, and that would protect you from any upside risk on that interest rate in the future, were that to happen, right?
Yeah. So who sells those?
Well, big banks, real big boys like, I don't know, JPM, Wells Fargo,
Credit
Credit
Suisse.
Suisse,
Credit Suisse.
UBS, Deutsche Bank. And so, there was a point in time which the Fed raised rates going into COVID. And, obviously interest rates in the future didn't look bright with the pandemic getting worse. And, these banks took on a very significant amount of uh, inflation swap protection, right? They would act as the counterparty that, inflation wouldn't be higher in the future and we didn't have to worry about it, right?
Man, they must have sold that for real cheap, huh?
They probably, yeah, it really didn't look that bad back then. I don't think they were prepared for JPow's money printer to turn on the way it did. And, I think it was just very much business as usual against a lightly inflationary environment. But the difference is that, as we know with SVB's collapse, that these banks were inundated with depositor credit, and nowhere to put it. And the best place to put that money, obviously, is in something, tracking the risk-free rate that's going to be, uh, you know, guaranteed by the federal government over a period of time. And so these banks, obviously, as we know now, very obviously, rolled all of that depositor money into treasuries, which at the time were, trading at what, like 1.8%, 2% yields, extremely low compared to the current environment. Um, and they took the necessary steps to hedge against any future inflation, which looked like it wouldn't be too heavy, by taking on swaps with these larger banking entities. And so, what we're going to show you here is why we think the market isn't being allowed to crash, and why the media sentiment seems to shift so strongly one way to the other, over this very cyclical period, and maybe kind of outline and identify what is slowly becoming a market OPEX cycle.
And I think we should definitely, we've already prefaced it, but I think we should double preface this with
There's a
we
lot of
can't
tinfoil,
prove
yeah.
any of this. There's a lot of tinfoil, a lot of speculation, but it's I guess I suppose it is an exercise in mental masturbation, and it's fun.
It's a fun one, yeah. So
Well,
I think the
good
first
thing.
things that we should look at are the DGS 10 and DGS 30. These are the rate at which hold to maturity securities are becoming due, on the 10 and 30 year respectively. And then I think we should look at, as you can see, they've gone up significantly. More and more of these securities are becoming due as we move through this bear market. Many of these securities, bought back in like 2012, 2013, right? Right, kind of at the bottom of the housing market, and those are starting to come due now, and interest rates at that time were extremely low, right? um and then we'll take a look at the US 30-year yield, and which is that green line. It's a little hard to see, but it's there. As you can see, it's very much in line with the rate at which 30-year maturity securities are coming due, and those are from the late 90s, um, which was also a very low interest rate environment. And we can look at the 10-year yield, which is also matching with the 10-year 10-year securities becoming due. So I guess the next most important thing to look at is bond futures prices, right? Where are bonds being bought? And as you can see, bond prices are dropping, and they are dropping in relation to equity prices, which is not the way this should work, right? Obviously, bonds should be inverse equities. Equities go down, bonds go up, yields go down when bonds go up, but yields are going up, bonds are staying flat. Dork, would you like to take a little bit from here?
Sure, I can go from here. So kind of what got us thinking about this was, there's points in time, like you kind of have to do a little history lesson, in terms of what happened from 2020 on. Fed dropped rates to zero in 2020, right? But there was a lot of stimulus, and so consumers were depositing a bunch of money into banks, right? That's kind of how stimulus checks in a secondary effect, stimulate the economy as they increase the deposits for banks, so then they can go and buy treasuries, right? At the same time that happened, though, there were people who made decisions, namely like Michael Burry and I think Ken Griffin at Citadel. They realized that the inflation risk from the printing of the dollars was really high, and inflation was almost guaranteed because they're not following modern monetary theory, I believe, right? Where they like if you believe in I think it was Milton Friedman, who says that the money supply is pretty like inflation is a function of the money supply. With that theory, when the money gets printed, the risk for inflation goes up, and so the reasonable trade to make to profit off that would be to short treasuries. So that happened a little bit in 2020, later 2020, and in 2021. And then people were also re-upping on treasuries too. And you can see actually in the yield curve, sort of where the bond market was telling J-Pow, hey man, you should probably start raising rates. And that happened like at the beginning of 2021. But J-Pow said inflation's transitory. We're going to keep rates low. J-Pow's the name, risk on's the game. And so that's, it flattened out the yield curve a little bit. And then, but the thing is around the time that J-Pow started saying some pain, this inflation may not be so transitory, we should retire the word transitory. Around that same time, all these banks that have been loading up on treasuries, thanks to all the stimulus checks, increasing the deposits to their assets, they, this time around, maybe they're thinking to themselves, maybe we shouldn't be loading up on treasuries anymore because they're just going to keep dumping in value. So what we'll do is instead short treasuries ourselves, or as Girk said, enter swaps, inflation swaps, to hedge that duration risk, right? And that's how you make sure you don't end up like SVB when you have to unwind a bunch of capital to help depositor outflow. So that started happening when J-Pow started raising rates, right, in March. And then full Volcker in June, same thing was happening. I think that there was a lot of downside hedging going on in these bonds. Downside meaning like upside yield hedging on these bonds. So what we saw when SVB collapsed, perhaps it was, purchasing of bonds due to depositor inflows to large banks. But the thing is no money was really necessarily created. Money was kicked around, but it didn't just go, like there wasn't just all of a sudden these people like, you know what, I'm going to take my 50 grand from SVB and I'm going to put $1 million of it into JPM. That's not how money works. So I think what really happened was possibly covering in one form or another on the SVB news by these banks as they were trying to do a lot of housekeeping on their current position. And then they were expecting for rates to be cut, in which case they don't want to hold these, quasi short positions on treasuries anymore. They want to reduce that exposure to the upside in yields. So that's why we saw, everything drop in a crazy fashion with ridiculous volatility, kind of like what you see on GME, right? Sort of the same thing where it essentially, if you look at it, instead of looking at the yield, you look at the bond price, it looked like a little squeeze with a crazy amount of volatility before it kind of calmed down and it's picking back up again. And you could say this is a big flow into money market funds. That's that's reasonable, but it wouldn't lead to that much volatility if that was the case. So there was definitely a rush for the exit of some kind in March, late March, that is still sort of resolving. And I don't think it's completely resolved, but that explains the narrative shift from the media, from the odds of 50 basis points versus 25 shifting to 25 versus 0, and now the pricing in of 2 rate cuts by the market by year end. And people going onto the news and saying we need to cut rates, we need to cut, pause. All that sort of talk was, directed at the Fed to try to get them to not push rates higher, because if they do, that upside yield risk is no longer hedged. It may be getting hedged now, who knows? Because we're in kind of a new environment. But that I think that there's definitely a lot of how do I explain this? There's a lot of volatility risk in yields right now. So J-Pow continuing to raise rates at this point after SVB's collapse, and this mad rush back into long yield. I think that there's actual the duration risk, I guess you could call it, still is back. It wasn't that big before, but now it is back, because people thought that, okay, the duration risk blew up. Now the Fed is aware of the duration risk and they will reduce the duration risk. And instead, Jay Powell has gone on stage and said, we will keep doing what we're doing. We don't care. Have fun. And that's why we're seeing this sort of shift back into short treasuries, right? Where yields are continuing to move up after the FOMC minutes were released. And that could partially be to just try to get yields more in line with the Fed's expectations. But it could also be a return back to that hedge on duration risk. So, there's a big risk out there right now in the market if there is this sort of hedging going on, that a sudden drop in yields or a sudden spike in yields could potentially be catastrophic.
Yeah. So there's a very, very distinct correlation between high yields and low treasury prices, obviously. When yields get high enough and people start buying into them, the market starts going down, right? And what we're seeing is, I think, we're seeing a heavily entrenched short position on treasuries defending itself. And the reason they're short is because they went long on inflation swaps back here in 2020. And they went long on inflation swaps here before the money printer got turned on. And so if you're long on inflation swaps, you want to short treasuries, right? That's your hedge. And now yields are, not only have they broken up once, they've broken up twice. And now they're getting to the point where, they're seriously threatening future growth. Because future growth, due to the Fed's policy and economic conditions, is declining and yields are going up. And so, the encouragement for participants to get into lower risk and now potentially higher return bonds is increasing, right? Which jeopardizes these deeply entrenched treasury shorts. And I think that's why when the market starts to get near or approach any kind of crash conditions or conditions that would maybe drop the S&P below or to its more standardized PE valuation. We see this sudden run in price, this outpour in the media about how we're in a bull market. Everything gets bullish, right? I mean, if you go back in time and look at the news articles from, every one of these periods, uh, everyone's full bull, like everything's fixed and it's all recovered, right? And then, eventually yields catch up with the sentiment. People start buying yields, which puts pressure on the Treasury shorts, right? And then, they've got to go long VIX and short equities to hedge. And then everything comes tumbling down really, really fast and starts all over again.
It's an
So
effective cycle while the Treasury market is stable. That's for sure.
Yeah, but now with future growth reducing, the incentive to get into bonds is only increasing. And if there is a surge in Treasury buying, like we saw very recently with Move, when everything started to collapse, right? And the banks started to fail. Uh, that's going to drive up. That's going to drive up prices. On treasuries. It's gonna fuck the shorts.
Well, and also as lending standards tighten, that doesn't just mean lending standards for mom and pop getting their, another refinance on their mortgage, right? Or it's also interbank lending that's tightening as well. So,
Yep.
overnight lending is drying up, which means the only place to get those yields is slowly just becoming treasuries, right?
Yep.
So that right there also presents a major risk.
I wonder who
yeah,
short treasuries. The big banks. The guys who took inflation swaps projecting 2%, 2.5% future inflation and are now staring down the barrel of core CPI at like 5.3, 5.6.
It's a really precarious position too, because it's kind of like a buff dude pulling on the TheraBand, right? He's pulling really, really hard. Nothing's happening, but there's just so much tension in there that could just snap.
Yeah.
yeah, I
But
think yeah, when you guys first sort of started pulling me into this rabbit hole that you're going down, I I I try to scoff at anything tinfoily, so because I like to resist the idea of an echo chamber, but I'm naturally my wife thinks I have ODD, which is oppositional defiance disorder, which is probably true.
It is.
it's absolutely true. She's right.
um, anyway, yeah, I pushed back on it, but the more I thought about it, the more it was consistent with all the things that I've been looking at as well. Like because, and I don't know how much. I mean, everybody's kind of been saying, "Oh, the VIX is broken. The VIX is broken." But it actually is extremely odd what is happening with the VIX right now. Odd in the ways like this isn't something that just happens every year or every few months. This is a very bizarre behavior from the VIX, and I've been looking at the options chains and trying to dive down at a more granular level to try to figure out, what's sort of the positioning that's going on, what is the ultimate strategy here, and I mean it's just shocking how much how much positive delta has been pumped in at strikes below 4,000. It's insane. There's more positive delta that has been pumped in the last, since the banking crisis happened, below 4,000 or even below 3950 than there has been above 4,000 by like a strong magnitude. And it is mostly out of the money puts. And it's positive delta means someone is selling, someone or multiple entities are selling a massive amount of out of the money puts to try to prevent whatever it is that's about to happen in the market. Because you look everywhere else, I mean, if you just look at ETFs, for example, this year from January to now, if you look at the SPY, uh, I think some of whatever the biggest ones are, both the Nasdaq and S&P, for example, net outflows from those funds are like minus 3%, right? And then you look at the returns in the market, and it's like plus 7%. So there's a 10% differential, and where the money's, at least the evidence we can see where the money's going and what's happening in the market. And so it really can only be explained primarily by other derivatives, propping this mess up. And so yeah, so it was quite interesting to hear this sort of elaborate plan of why some people who are large, right, the large banks and market makers and the like, need this behavior to happen. Yeah, go ahead.
I was just gonna say it's if this is sort of what's going on, and like this is the actual risk that is being hedged, then I just want to emphasize how crazy it is for it to be bleeding into the volatility market as strongly as it is. It would be like utterly mind blowing.
But I mean, this is it. The reason that I find it so interesting is because it's not only the options market that's acting quite odd, right? Especially the volatility of the options market, but it's also, like you guys have been discussing, this idea also sort of fits with the evidence that we've observed in the move in the bond markets, looking at where the money's flowing. Money is flowing primarily into government bonds and not into corporate bonds. There's some going into lower risk corporate bonds, but high risk corporate bonds, people don't want it. People want U.S. Treasuries. But at the same time, the market's going up as money is leaving the market and flying to Treasuries. And so it's a very bizarre situation, and there's a lot of different derivatives and just fundamental instruments and their derivatives that are all acting in a bizarre way by themselves, but also in concert with each other. It's just a very bizarre dynamic that's occurring right now.
Well, it would make
And this
sense
theory,
that we see so much. It explains why we see so much unity in the positioning for what is relatively short-lived pumping, right? Like generally, you don't see every participant in the market doing the same thing like that. And we have been, right?
Yeah, I mean, it's certainly everyone who's short right now in the market has been really frustrated because it just seems like the market just pops upwards, but has to just dig for every millimeter on
What
the way
is
down.
move? Move is bond volatility. It's this line right here. Bond volatility has been increasing over its average in the last year,
which is highly unusual for bonds. Bonds are traditionally a fairly stable environment. And obviously things are different now because rates are increasing, but even with the increasing rates, it's bizarre.
So how low do you think you need VIX to hedge a massive treasury short position? Like how free do puts need to be?
As close to zero as you can get, bro.
Well, sure, as close to zero as you can get, but you have to think about, what is the actual risk, right? As most people know, or maybe they don't.
Show move in 08, do it.
So I think most people here are probably aware, but I'll just say it very quickly just in case. Prior to some crash in the 80s or 90s, I don't remember when options were still relatively new, everybody loved Black-Scholes and treated it like gospel. Black-Scholes assumes that all of the probability, the future probability of movements in the market follow a normal distribution or a completely random walk. Okay, and so IV, the number that is attached to each option in the chain and is different today. Back then they were all the same, right? So if IV was on the SPX was 17 at the money, it was 17 at 2000 as well. And ultimately, what they found was that it didn't follow a normal distribution. There was a fat tail to the downside that they weren't properly pricing in. And so that was the birth of the volatility smile, where IV goes up as you go out of the money or as you go away from the at the money or the spot price. And the height of that, how much it curves up is a function of the perceived risk that the market maker sees to the downside. And so you think about, like, even at the money, what is occurring is that the smile is not nowhere near as high up as it should be or as curved up as it should be. And so what's happening is that these market makers are taking on a fair amount of risk by selling these options. But I don't think it's the market maker selling these options. I think it's somebody else selling options to the market maker. And of course, the market maker is going to say, well, hey, if people want to sell them to me, I'll buy them for cheap, right?
Yeah.
I'll drop these prices like a rock and I will buy those from you for nothing and I'll hedge them, right? And so the person selling them gets the market movement that they want, and the market maker loves it because he's selling shit for cheap. But
Yep.
once this starts turning around, all of a sudden the market maker says, oh, hold on, people are starting to buy these things and I've been underpricing them because I want free money. So he's going to just crank up the IV really quickly so that when people are buying these things, they are paying an appropriate amount for that risk. So people who are buying out of the money puts right now are, if they're getting enough, theta to realize, some of these movements, because it's hard to time it, they're likely getting these puts for quite cheap. And if you think about the historical volatility of the market itself, which is sort of a gate, you can kind of expect that previous volatility will beget the future volatility. It's about 16.3 on the SPX. 16.3 to 16.5, of the past 30 days, 20 or 30 days. I'll have to go back and look at it. And so it is basically at that point, if they try to push IV at the money below that point, they're basically giving away every single put. They're giving away risk for free. And so I really don't think that we're going to be able to see a VIX below 16. I mean, the obvious mispricing of risk will be so large. But maybe if all the big boys are all selling puts, maybe there's no one to buy them. I don't know. It's a very strange, bizarre scenario, but I think puts are too cheap.
So one last thing that I want to show here, the 2-year risk generated in this period when the money printer came on and Treasury got shorted hard is now coming due. Right, the 2-year Treasuries are maturing now, right, which is going to spike yields again, right, because this is a huge number of Treasuries maturing through this period, especially the 2-year, which is by far the most popular. Those are going to be coming due over the next like 3 months. We've already got, bond volatility is sky high compared to the historic average. We've got yields that are sky high and we've got treasuries that are rock bottom, right? Quarter 1 earnings is going to tell us that yields are surpassing growth. Maybe not in every sector, but in almost every sector. Yields already surpass current tech growth in Q4. I can't see Q1 being any better than that. But something to note is this, and this is the average rate of SOFR
Hey,
swaps
Kirk,
coming
just
due.
really quickly, just a data point to assert what you're talking about. TSMC, because they give their monthly their monthly numbers, we already know that their year-over-year growth for this quarter is like 3.3 to 3.6 likely. So that confirms what you're talking about, that that in this quarter, these growth percentages are underneath, what you can get from risk-free bonds.
Yeah, this significantly, right? This is lower than the 30-year, which is now at 3.7, I believe. If the 30-year hits 4%, this is all going to go to shit anyway. But so the SOFR weights the 30, 90 day, 30, 90, and 180 rolling period in an index, which is one of the only things I can get here through the terminal. But I think people might be really interested to see what the SOFR index looks like during this period and how much behind the scenes swap risk is occurring. And out here on the SPX chart, it's probably not going to look very impressive, right? That doesn't look like much. It's like curling up through August, right? When those yields started to skyrocket. But if you pull the SPX away, and really just take a look at the index itself, it's doing a thing.
This right here, this is why Dixie below 100.
Yeah, if Treasury squeeze, Dixie way below 100.
Whose feet are getting exposed if it's under 100? I forget, Dork.
Mr. Poopy Pants.
Oh, shit.
Nice.
That's right.
Stonk daddy, purveyor of feet.
The VIX not making sense could be poor quality paid data being analyzed.
No,
I think we have
I don't
all
think
the
that's true.
granular data for the VIX.
Yeah, and you can get the VIX. I mean, you could get the data you need to talk about the VIX. I'll defend this a little bit since I do a lot of poking around in this area. I mean, that's coming from. It's consistent across many different sources. It's not. I don't believe it's poor data.
That was Stefan who asked that. So,
Oh, Stefan, something's about to break out from a rounded bottom somewhere, and Stefan will get its wings.
Mr. Poopy Pants, I don't think Powell's going to be raising by 100 basis points. I think Powell's got an extremely tough job because he knows all this stuff too. He knows that if he does raise by 100 basis points, he pretty much blows everything up. All of this stuff just completely explodes, especially if he doesn't telegraph it, right? Any untelegraphed move by the Fed without at least a few months of advance notice could be potentially catastrophic.
Yeah, because remember, I mean, that's the biggest issue here is that core inflation is still going up.
Yeah,
and he doesn't want to be. He doesn't want to literally make the same mistake that was made in the past, right? It's always fine to make a slightly different mistake or a different flavor of a mistake, but to make the exact same mistake that was already made in the past and learned from, I mean, you can't be responsible for that. He's going to raise rates. I don't think he's going to raise them over 25 because it's not completely up to him. It's everyone, right, or all of the voting members. But yeah, the rates are going to keep going. I don't see. I only see evidence that we are turning around, right? So used cars look like they're going back. There's some indices that look like they're going back up. There's data, everybody is really relying on data that hasn't borne out in the official numbers yet from places like Redfin and Zillow and others who try to project rent prices, right? But a lot of their data is, number one, it's inaccurate. I think we all need to remember that their data is inaccurate. For example, in the state of Texas, you do not have to report what you actually sold something for, right? Or what you actually rented something for. So what they have is what's listed. They don't have any information on what things are going for. and that varies by state to state. But the point is that they have incomplete data, and they have problems with their data sets. They also have to try to presume that the data, the statistical weights that go onto all of their data, from the data that they have from the listings that were listed on their website, are proportional, right? Which is also problematic. And so everybody's really just hoping that rents are coming down based on all of this data that has problems and uncertainties with its statistics. And I don't think that I don't know that I hear people saying, "Oh wow, the rate dropped or the rate went down here or there or prices stagnated." I just hear everybody complaining. So I don't know. I don't see things coming down. Goods are turning around. Energy's starting to go back up. So the Fed is, they have to raise rates, and they have to.
God,
Yeah, I think the
Stefan's
market's
starting
preparing
with his
for
euro-dollar shit again.
that. Jeez.
Uh,
So
I'll have to read more about it.
he thinks
thank
that
you,
the
Gary.
Fed has no control over the euro-dollar market, which they do, and they monitor it. He gets the information from various YouTubers and from Ray Dalio's fucking please get calls on China speech that he did right before he retired. Which has worked out so well for all the people that got calls on China. I don't want to get into it. And his incessant fear of BRICS ever coming to fruition, but I think the thing we should talk about here is what are the outs to this buy bullets not puts potential catastrophe. Um, One of them is the Fed raises rates extremely aggressively.
Yeah, I think this is probably the best possible solution. But the thing is that this has been the best fix since 2021, and they've just been dragging their feet on it.
Yeah, but I don't know if they have an option now with inflation becoming entrenched.
Yeah, for sure. It's the environment has changed significantly even between 2021 and now in terms of the monetary
It's
situation.
changed between January and now.
Yeah, and the money supply dropping precipitously as it has is not good, especially with inflation still rising.
So that's one solution. This we may not see. I'm sure Powell is as aware of the situation as we are. The other solution is the Treasury can step in. They can fix pricing on treasuries and provide liquidity in order to stabilize the market.
But to do that, don't they have to raise the debt ceiling?
A
They
lot.
do.
Yeah, massively.
They have to do it if they raise rates too. I mean, because you have to
Well,
service that debt.
Yeah.
didn't Janet Yellen say something like she was willing to accept something like 50 trillion in total debt over the next 10 years or something? It
Yeah,
was,
This would use
and
up about all of
making
that.
an argument about, it's not about the total number, it's about the cost to service the debt, which I actually kind of agree with and have agreed with for a long time. It was a great way to think about debt when there was almost no interest paid on debt. But that could quickly blow up in our faces here. Obviously, everyone's still hoping we go back to low or no interest. So, I don't see the Treasury really being able to do enough
The other one
here.
is that Treasury shorts Treasury shorts can go short indices. Currently at very cheap prices, right? To hedge.
The Treasury or Treasury shorts.
Treasury shorts.
Okay. So yeah, the first two outs. Well, the first two outs require they require the government to put up a lot more money to finance the debt, right? I guess the Treasury.
I don't think
Right.
this would break. I don't think this can break down without some significant regulatory step in.
Yeah, if you don't, if like, because the risk of a sovereign debt crisis, goes up significantly as rates get increased further, right? Especially
Yeah,
with how much money is in the market now and how many of these treasuries are out in the market. So that's a big problem. They'll have to raise the debt ceiling significantly. 50 trillion might not even be enough in the
yeah.
long term. The Treasury shorts going short indices to hedge, I like it, but that doesn't necessarily fix the monetary issue.
No, it doesn't.
So, I mean, that'd be a nice little band-aid provided by private capital, but I don't think that would end up being a
Oh, don't
result.
worry. Private capital will provide the band-aid, right? Because J Powell will pull back the on RRP to get the liquidity back in the market.
Yeah, and that's I think that's kind of what, if there was going to be an aggressive rate hike, then there would have to be some adjustments to overnight reverse repo to facilitate an orderly move up in yields, right?
Yeah,
But it has to be a one and done, because you're gonna, if it's not enough still, then you've just compounded the duration risk, right? And you've added C4 to the pile of dynamite that's in the treasury market right now. If inflation does not turn over after such a big bombastic move, right? The risk, like you're kind of going all in at that point.
I mean he has to Volcker it, right? Like
Yes.
yeah, because he needs the federal funds rate above the rate of inflation, and it needs to be held there for a period of time.
Yeah. No, he
Otherwise,
needs to.
entrenched inflation will persist. Yields will keep, leapfrogging themselves. And, treasury shorts will just have to go harder into treasury shorts in order to offset the risk of their inflation swaps that they sold that yields that were, 2-3%.
Yeah. It's a complex issue. Um, and the solution really needs to be, we have these three different organizations, the legislators, the Treasury, and the Federal Reserve. They're all trying to come up with what solutions they can separately, but they all need to come together to figure out how to finance, or at least, shoulder the brunt of the blow from an extreme move like what is necessary to get this under control. Otherwise, the traditional buy and hold on equity. Sure, if inflation gets entrenched and just continues to move up, the indices are going to move up, right? That's just how
Yeah.
inflation works. It's a function of money supply. The indice prices are too. Like, you're going to get fairly consistent growth with inflation, but if it gets entrenched and the economy starts slowing down, now we're looking at years of traditional buy and hold not outperforming inflation, which is really bad.
I mean, it usually doesn't anyway. It's just not a known quantity, right?
Right.
How dare you? You can't say things like that to people like me.
Yes, I can.
Yes, Mr. Poopy Pants. I believe stagflation is around the corner. We
Yeah,
probably won't see it.
that's another reason that the Fed needs to pursue more aggressive rate hikes, right? Is that, you know, uh, we do have durables inflation and it's persistent, and we have the beginnings of labor slowdown and definitely the decline in wages, right? And so, prices remain unstable and inflation is becoming entrenched.
Yeah, I mean the issue is that inflation we haven't had deflation, but we've had crazy inflation, and then we're trying to just pause. We're just trying to hit the pause button on prices right now, right? That's kind of the goal, is to hit the pause button. But what if hitting the pause button isn't enough for the bottom 60% of earners, right? What if that
Yeah.
pause, it could be enough in 5, 10 years, but how do we know that, one, that in those 5 to 10 years inflation doesn't come back, and two, whether or not the bottom half of income earners can of water with prices as high as they are, even if they don't go up any further, if their wages don't get better in that time period, right? It's not a guarantee. So I think there needs to be some real pain, and there does need to be deflation in some capacity, at least in durables, in order for this to kind of equalize.
I mean, you can make it sound as fancy as you want, but what you're basically saying is we need a crash. We need
a crash in assets.
We need leverage to unwind.
We need because a crash will not happen on its own, right? Because market participants don't want Treasury, like big market participants do not want Treasury prices increasing. A crash needs to be forced.
Yeah, but I'm more talking about prices of assets more so than prices of like consumer goods necessarily. Like the cost of eggs and stuff. Sure, those deflation in those, that would be a really bad sign for the economy. But things like house prices, car prices, washing machine prices, these sorts of things that have some sort of value as an asset, even if it's depreciating, they need to come down. Otherwise, the equity distribution in America is only going to get further concentrated, and the risk that comes along with that is much greater, right? That you're talking about risks, societal risks almost. When that kind of thing happens, I don't think that America in particular is too big of a fan of you will own nothing and be happy. And once it becomes widespread enough, you'll get some serious backlash throughout the economy.
This was a good question. I'm kind of looking at this was actually a decent question from Stefan. I'll give him some credit where it's due. He asked a decent question. What's another workable theory that inflation is not being lowered in spite of such aggressive rate hikes? And I think this falls in line with what we're talking about with stagflation. And somebody else asked, explain it like you're five. Kind of, I'll give you sort of an idea of kind of what I see playing out in the housing market. Imagine that you're somebody like me who got into a house in the last few years at a mortgage rate of 2.85%. The housing prices had started to go up but hadn't peaked, right? So housing prices have now continued to go up. Now we're at a point where housing prices are high, and I will die in this house with this mortgage. I will never get rid of it at these rates and move to somewhere else, right? I don't care if you can refinance or whatever. I'm holding on to this thing till the day I die. And most people who are already in these homes feel the same way. Everybody right now has almost everybody has a mortgage below 3%. Nobody wants to move. Well, yeah.
Me neither. Yay.
Everybody who owns a home.
I own a home.
Fuck off, Dirk.
Let's just give me the benefit of the doubt here. Everyone who owns a home with a mortgage does not want to get rid of it. So the housing supply has basically evaporated as people are unwilling to pay the premium that would be required to get people to get out of their cushy mortgage that they're on. And so what happens is that you have to wait for new people to build houses, and there's no incentive for a builder to build below the current market rate, right? And so you have a situation where liquidity goes down or activity goes down, but prices continue to rise, right? And that's kind of like that stagflation idea, where nobody wants to, people would rather just produce less than be the one to hold the bag. And so everyone's just like, well, I'm not going to hold the bag, you hold the bag. So it's like the whole economy just goes on strike while things continue to move up.
Yeah, and the risky part, the scary part of all this is with stagflation too. Once economic activity slows, right, as the cost of goods becomes too high, margins collapse, and once that happens, workers get laid off. These people who have these homes with these cushy mortgages, maybe they lose their job, and the cushy mortgage, it was on like a $600,000 house at 2%, but your monthly is still like, let's say, $2,200. You get on unemployment,
Well,
you can maybe make that for a while, but
let's
once
not
you have,
forget a really important factor of the housing market through that period where those loans were 2%, right? Those home prices were 100% over the fucking fair market value.
Yeah, it depends on place, right? I mean,
Yeah,
my
true,
my
but
home isn't 100% over, but it was. I mean, my market's fairly stable. Over the long period, it grows about 3% a year. But yeah, it was going up 7 to 10% a year for a little while here. So I overpaid for my home a little bit, but I'm willing to, I don't intend. We have a fair amount of job security, so I don't have any intention. I'm going to hold this to maturity, basically, is sort of the idea, or at least until everything breaks, and then I wait for that sweet spot to move out again, or
yeah, I
maybe
guess
I don't know.
so. So the regions this would be most likely to affect is like Salt Lake City, Boise, Idaho, Houston, or Austin. I mean, just like some places where the tech diaspora, from post-pandemic sort of led to for a lot of these people in the West Coast,
San
probably be the
Francisco.
most heavily affected.
Yeah,
But
most of the drops that have been seen by these commercial companies like Zillow and Redfin, et cetera, has been on the West Coast in the tech heavy areas, and
Yeah.
so that's starting to unravel a little bit, supposedly.
It's starting to unravel on the East Coast too.
right, but so the scary part though isn't even so when the screws get put on individuals who lose their jobs in these homes with these mortgages and these high prices is twofold, right? So let's say they're in a position where they have to sell and go back to renting, right? Because they found a job at a lower pay. Now they're faced with the decision or they want to just downsize their house. They have to do something to reduce their monthly expenses. Their choices in this market, especially at the beginning, are going to be extremely, extremely perilous, right? You either move into a smaller home for more money at a higher interest rate, or you go to rent at a higher rent, right? And once people start having to sell, these asset prices, the prices of these homes is going to drop drastically as there's a rush to the exit.
Well, yeah, I
Supply
mean,
goes up.
you kind of have to
Yeah,
think about just statistically, though, right? Because the employment market, right, is definitely showing signs of cooling, but it has not gotten to the point where anybody has said, I will hold the inflation back. And the thing you have to do to kill inflation is make somebody hold that back. Employers don't want it, employees don't want it, and the government doesn't want it, but somebody's got to hold it. And so right now what we're doing is we're all just playing hot potato and passing it around and saying, you eat shit. And you pass it over and say, no, you eat shit. And this will continue until we are forced to either eat some shit or lose everything. And so that's kind of what Volcker did to kill inflation way back when he said, I'm just going to jack up rates so high that you guys either hold the bag or lose everything. And then the system resolved it, right? We all took our lumps and moved on.
Except if we do that now, this on a humanitarian level should be noted that if the U.S. does Volcker the federal funds rate, we will destroy almost every other economy on the planet. And our
yeah.
quest to spend a little less on our eggs. Not that I'm saying we won't do that. We are greedy assholes, but we will. It will be very bad. It will likely lead to war.
Yeah.
It'll actually have to lead to some kind of
I
war.
mean, yeah, I don't know if it's yet time to start getting that extreme, but I have started to get really, I mean, I've started to bear a lot of frustration with the markets and with consumer behavior, especially in the last, 3 to 5 months. It's just like, come on, guys, all we have to do is just spend a little less for a little bit, right? Like, and nobody can do it. We refuse to do it, and it's almost like, the petulant child that just wants something so bad that they'll jump off a cliff after it to try to get it, and
We're a very
it,
materialistic society.
it just makes me
Yeah.
so angry to see this euphoria, all this discussion of, oh, inflation's over. Well, it's exactly that discussion that's going to cause more inflation. I mean, you look at Bitcoin and all these, speculative tech assets, the most speculative assets have all gone up 60 to 100% in 3 to 5 months. I mean, that's the kind of euphoria that's going to respark all of this. And all we have to do is just not do that. And it will be an easier time for all, but we're clearly not capable of it, and it makes me angry.
It's almost more of a failing of like just the general public and the government, right? In terms of educating people on the economics, right? Like, if everybody in America was well educated on how inflation works, right? If things started getting more expensive, right? And people do this to some degree, you can see it happening, but as things get more expensive, right, a well-educated public would do things like pull back on big purchases, right? And they have to some degree, but not to the degree that they theoretically should have, right? In JPow's world, they should have pulled back a lot more and literally not bought a single house once they got, over, 150%, like over, 1.5, 2 standard deviations from their average price. They wouldn't go that deep into it, but they'd say this house is too expensive. I'm just not going to buy a house, instead of saying this house is too expensive, but the mortgage rate is 2%. So, we're good. And plus, I just got a new job at Facebook, drinking lattes and posting on TikTok, so I'm good to go.
Well,
That's
yeah, I
that.
mean, here's the problem is like half of the fucking houses bought at 100% of their fair market value are going to default. And then all of the houses bought at 100% of the fair market value with 6% fucking interest rate are definitely going to default, right? And this
They'll
is
default
just
faster,
like,
yeah.
yeah, but not much after, right? It's just going to create a cascading effect. Meanwhile, and I do want to talk about this real quick, JFresh, builders are building. The cost to build a home right now is far below market value. Lumber's down. It's
I
cheap.
know.
Permits are going up. What builders are doing is they're building houses and selling them below market value, in large quantities. All the big like KB homes, all of them are building nonstop right now, and they're saturating the supply before these people have even started to default.
Yeah. No, I mean, I don't disagree with you. I mean, the builders are effectively offsetting these high mortgage rates by trying to come in and, because it costs them less to make it, they can sort of offer some of that savings to the consumer to offset those higher mortgage rates and incentivize buying. But still, I mean, if you look at just monthly payments, those monthly payments are still going up for the
They're
for the
fucking
consumer.
ridiculous. It used to be, 3 years ago, you were paying like 2,200 to rent an average house in the U.S. between 16 and 22, right? Now, and to buy one, you were paying between like 12 and 18. Yeah, this is what the advantage in buying was, right? And then, since rates have gone up, these are now like 2,200 to like 3,800. And then this is like 2,500 to like 4,000. So, where are they going to find the renters? And then the rental supply from people who already own their homes or own their homes at these rates, are going to, be able to massively discount ahead of these. So renting's not going to be an option like it was through, 2012 to offset that loss. You're simply just going to run into a stagnant rental market where, you're outclassed by anybody who's in their home slightly cheaper.
Yeah,
I
and
mean, it's when things change quickly, right? It's there's a lot of inertia and inertia that accelerates rapidly. Mass that accelerates rapidly is quite painful when it hits, right? But
we should also take into consideration the cash buyers, right? There's been a big influx of cash buyers since 2020, 2021. These guys aren't sitting on interest rates, and they're solely planning on they're buying up cheap homes that needed to be fixed up and they were fixing them up, right?
Yeah.
And they're still sitting on positive equity for the most part, right? But as soon as these cash holders, because they've been buying these homes as speculative assets, as soon as the asset price falls below what they paid for it and put into it with their renovations, they're going to drop these things.
Yep.
And
As soon
especially
as it falls close.
yeah,
especially
they
if
won't
Treasury
take a
rate
loss.
also beats their yield on the rent, like that's also big. Like a BlackRock, they don't want to hold a house that only yields, like 2% a year or 2.5% a year when they could just be taking out, 30-year treasuries, right?
Yep.
At 4 or 3.5, 3.6% now, I think is what it's at.
3.7.
3.7.
Yeah, but I mean, back to the whole like crashing the world and just all the pain that's gonna, you think about, and I know that obviously I have the privilege of choice, right? Being in the middle class, but you think about folks that are paying, over $1,000 a month for their car payment. If you're poor, you can find a car, even if it's a piece of junk, right, for way less than that a month. But there's a ton of people who are, it's like 16% of all new car loans are now over $1,000 a month.
Yep.
Mr. Poopy Pants, I'm upper middle class. Don't at me. And you think about like how much less painful this would all have been if people just refused, right? Like I don't, maybe don't buy a car that costs over $1,000 a month with all of the bells and whistles and the moonroof and whatever else shit that comes into it. It would be so much easier to unwind this and so much less painful if we just stopped taking so much leverage into the face of inflation that has to be crushed, right? I mean, we're just begging for this to just crash hard, and it makes me so upset. Ugh. All right, anyway.
Well, enough doom and gloom for the Sunday.
Yeah,
Yeah.
I got to get back to it. I'm gonna I'm sure that everybody hates me now because I've been in my office for a while. Yeah, things look great. SPX to 4,400. Let's go.
Yep. That's great. Taiwan Semiconductor to 4,400 as well.
Yes.
Yeah, why not? I mean, at this point, we're creating a subprime loan crisis by making everyone a subprime loan holder. In a way, yeah.
Man.
That's not the
Yeah,
most
and
inaccurate statement.
So earnings, by the way, just one last thing too. Earnings have been projected to be the worst they've been since the pandemic. This quarter, all the analysts are trying to set the bar pretty low.
Does anybody have the number on just really quickly the S&P 500 quarterly earnings projection? What is that now? Does anybody know?
Not off the top of my head.
Yeah, I just looked at a graphic this morning, but I forget. It was some sort of like earnings contraction. I think it was like around the area of like 75 basis points or something like that. But we could end up with a miss, right? We could end up with people updating their projections as well, because we're still, analysts are still in a way pricing in a V-shaped recovery in earnings, and I think this quarter we're going to find out if that V-shaped recovery is realistic or not.
Yeah.
Okay. Yeah. So it looks like currently they're projecting for the year the S&P to make about $220 per share or per effective share. It looks like quarter one, quarter two down like 6 to 8%. So like just a massacre. and then they're wishfully thinking that quarter three will be slightly positive.
You think that's
think
priced in with the SPX trading at like 25 times earnings?
Yeah, and then quarter four magically 10% up year over year.
Hey, look at that.
So
That's
there we
because
go.
the
So,
Fed's that's because the Fed's cutting rates, right?
and that gets us an overall growth of positive 0.8% because inflation's solved and we're gonna get it fixed.
Jesus fucking Christ, we're all
And then
doomed.
2024, 12.3% growth. Let's
Oh,
go.
yeah, of course.
Let's go. Yeah. So we're forward leading, right? We're forward leaning on the market. We know the market's going to go up next year, so let's start buying the dip now, right? That's what we got to do.
Of course, yeah. Nothing but bright future and sunny rainbows ahead.
Yeah. Exuberant.
Should I buy more guns and gold? I don't know what good the gold's gonna do you. At least there's an argument. I guess there's an argument for having guns, but that's just so you could shoot people who bought too much gold.
Golden bullets.
Golden bullets.
Well, guns and alcohol.
Well,
guns, alcohol,
this has been fun.
Yeah, fun talk.
Yeah.
All right, I'll catch you guys later. Thank you so much for coming on.
Yeah, take it easy.
Have a good weekend, bud. Have a good weekend, everybody.
Later. All right, guys. Thanks so much for tuning in. Yeah, we know, Stefan. TLDR market 1-2. I covered the S&P earlier. I'll have a more detailed one tonight and Pickles picks. Thank you guys for tuning in. Enjoy the rest of your Sunday if you can, if we didn't make everything too miserable. I'll talk to Gaff if I see him. Later, guys. Have a good one.